Welcome back, folks. It's a very special episode on Smart Money where we're discussing our children's future, as it is just 10 days away from Children's Day, and we have Vivek Bajaj here. He, of course, has been in the markets for over 17 years and he has 3 kids of his own, so he knows what he's talking about. Vivek, before the break, you were telling us about the different kind of mutual funds that one can invest into for your child, right? So I just want to get that plate up on board because there's a good mix of large cap funds. These are the funds that Vivek has chosen. Remember, don't go by the past, the historical performance, but going forward as well, these are safe, consistent funds. The mid-cap and the small-cap funds will also come up for you in a bit. There's Quant, which has done exceptionally well, PGIM as well. And in the small-cap list too, you have Axis Small-Cap. But there's also ETFs, right? Passive investing. Your thoughts on that?
I think it's a perfect thing to start because that gets you inside the market. You start looking at NAVs, which the concept of NAV is only comprehensible once you invest, and ETF allows you 100 rupees, 500 rupees to invest. So the best thing to ask your kid is that you start ETF investing because you will start understanding the instruments behind the ETF. So Nifty ETF is the most obvious choice because that's the most traded one. Apart from that, I recently did a study on Nifty Junior. And I think it's also very, very interesting because coming 5 years, if you believe that India market is going to grow from 3 trillion to 5 trillion, all these junior Nifty stocks will do very well because finally they will become Nifty stocks, right? So combination of Nifty, Nifty Junior and maybe a gold ETF to give you that comfort of currency depreciation as well as gold being an inflation hedge.
Okay, so gold is the next topic. Gold ETFs, do you prefer gold ETFs to sovereign gold bonds? I mean, your thoughts, because there's physical gold as well, but people don't prefer physical gold anymore because of the security risk, the making charges. So tell us, within gold, what should I look at for my child?
Well, I think both have its own merits and demerits. I'm more of an ETF person. But the bottom line is we have to invest in gold. Maybe 4 to 5% of our exposure should be there in gold. Because gold is not just about gold. It's also about currency depreciation. Yeah. And we all have to understand this whole science of currency. I mean, it went up from 80 to 83 and people are doing foreign education, so it has really hit their pocket. Gold, if you would have invested, if you have done SIP for 5 years, you would have made 12% CAGR. Even if gold looks like on dollar terms is an underperformer, but in rupee term, gold has still given you 12% CAGR. So it could be a souvenir bond, it could be an ETF. I'm more of an ETF person, but there should be gold in your portfolio.
Okay, so 4-5% of gold should be there in your portfolio to hedge against the currency move. And of course inflation. I want to talk about Sukanya Samriddhi a little bit because a lot of people recommend that for the girl child. I take it that it's tax-free, it's safe, but I also feel like there are better options. I mean, why lock in your money for 21 years at 7%? You can look at Bharat Bond, corporate FDs, but your thoughts on Sukanya Samriddhi as an investment tool?
It's more mental. I know there are better financial instruments, but the moment you target that this is for my daughter, it becomes kind of a moral obligation for you that, I have to do it. This whole term of Sukanya Samriddhi, that gives you so much of obligation to do it for your daughter. I can do it. I mean, I can get probably better return. There are many other instruments. But this is like a yearly commitment you have given to your daughter that, listen, I'm going to do it for you till you become 21. So I don't think so you should consider that to be a financial asset. Okay. It's more of something which you want to do for your daughter.
But you may need the money at 18, at 19. There's a 21-year lock-in. Don't you think that's not financially a prudent
I mean, you can decide the capital. No one is asking you to put large capital, right? From 500 rupees to 1.5 you can do. So plan things. That's what I'm saying. Sell A1. Start from sell A1 so that you can plan that, okay, I'm okay to invest only 10,000 rupees a year so that you don't have to really question that 10,000 in future.
Okay. So we've decided, we've, sort of chalked out our entire strategy on how to plan for your children's future. But coming back to talking about money, right? I wanted some tools for children. What are the kind of books that you would advise? How important is it to talk to your children about money, and what are the different resources that you can share with them?
I think the best resources would be internet and YouTube. There are so many book reviews. So get your student, get your kid, get away from all those gaming YouTube channels and give them some interesting book review channels. And there are some books which I did mention. I mean, the standard books and the psychology of money and other. Make it more interesting, make it more fun for them. Otherwise, books are quite boring for younger generation these days because we are not reading anymore. We are comfortable watching videos. So start with book summaries. That's a good option.
Absolutely. So there's Psychology of Money, there's Rich Dad, Poor Dad, there's The Richest Man in Babylon. I've read 2 of them. I haven't read Richest Man in Babylon just yet, but I've heard it's amazing. Are there any other ways of introducing financial literacy to your child, in the sense, you spoke about pocket money, you spoke about books, you spoke about different tools on the internet. Anything else that you'd propagate to, start the concept early?
I think let them earn money. That's very important. And earning money can be from a very trivial things like every morning when you get up, you have to make your bed. And I'll give you certain points because you have done that. So every day they should have a balance sheet of their own that, oh, today I made so much money.
But there's a debate on that, right? I mean, you're incentivizing your child to do something that he should be doing anyway.
Yeah.
So isn't that counterproductive?
Have you not heard the story of Krishna? Right? He wanted makhan, right? But, the mother used to ask him, you do this thing, then I'll give you. This is the most primitive way of motivating your kid, which has been followed in our rituals for many, many years. So I think we should not question that.
Okay, all right. So that's about children, right? But sometimes children are sorted. It's the adults who are most confused. So for all the adult viewers watching you right now, and you have so many videos on YouTube about financial literacy, what are for beginners? I mean, this is a show that a lot of millennials, a lot of Gen Z watches as well. For beginners just getting into the market right now, what are your 1, 2, and 3 top to-do list for investing?
Well, I think the most important is one has to understand this concept of compounding. It is widely talked about, but it is least practiced. Really, really, it's a powerful thing. And if you have that in your mind, it works fantastic. Second thing is habit, the power of habit. That consistency is so important. In stock market, I've seen as a full-time scalping trader to more of a passive trader and active investor. I've seen the more you have capital, the lesser your risk appetite becomes. In the other way around, people generally say that larger capital, your risk appetite is higher. No, that doesn't work that way. If you have more capital, you always have the mindset of losing that large capital. So your bets in the market or your investment or your trading call in the market becomes much more wiser with a larger capital. So when you have smaller capital, think in a very different manner. And as your capital is growing, you have to change yourself. And market is changing every 4 year, 5 year. Because the market microstructure changes. Thanks to regulator, thanks to the new technology, market is changing every 3-4 years. So your involvement in the market has to be in sync to the market. Otherwise, you will get disappeared.
Okay, well, those were some pearls of wisdom that are much needed, I guess, in today's day and age. Thanks a lot, Vivek. It was a pleasure speaking to you. And we have another episode coming up next week on our Children's Day special, a 2-part series. So do stay tuned into that. Keep writing to us with your feedback. We love hearing from you. Thanks a lot for watching Smart Money.